Hi everyone, it's Alex here at Quantitative Capital Research. Welcome to a very special webinar, which is all to do with quantitative signal services. And I want to talk a little bit about just how I personally use them in my own investing and trading, to give some examples of how it can be done. For those of you who don't know us, Quantitative is an SEC-regulated investment advisor. We're a slightly unusual investment advisor insofar as we don't manage any capital. We don't have any clients as such. All we do is publish investment research, and we publish so-called buy-side investment research, which is to say it's prepared from the perspective of investors and traders, not from the perspective of securities issuers. So if you think about sell-side research from investment banks and so forth, we're the exact opposite of that. We prepare research that each of us, the analysts here at Quantitative, use in their own investing and trading, and for which our subscribers who run their own capital, be that institutional, be that client advisory, or be that their own money, use it in their investing and trading. So buy-side investment research. We provide three types, and that's been sequential over our history. We started with fundamentals, we moved to technicals, and later into quantitative as well, and we continue to offer all three types. And I wanted to use this session to talk about how I use each type personally. Now, each of us have a different approach to investing and trading. Each of us have a different character, risk appetite, emotional and psychological makeup, and so on. Everybody's different, but I thought it'd be useful to walk through some personal examples of this. We run all our webinars on a live and open mic basis. So after I've read a disclaimer out in a moment, we will switch all the folks' mics on. So if you have questions, points, comments, anything at all, just open your mic and shout into the system. If you can't use audio or you don't care to, then there is a question and a comments function here in the webinar platform, which you can use. And as always, the recording will post once it's compiled, and we'll get that on YouTube. And anything that you weren't able to ask live, or if you're watching the recording of this, you can use the YouTube comments field for questions, points, comments, anything at all. Okay, so before we do anything else, let's just do a quick disclaimer on your screen now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at or intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Quantitative Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Quantitative Capital Research. Quantitative Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's get on to types of investment research. Now, the story of research is the story of the deflation of the cost of providing it. So for any particular branch of it, it was the case that to do fundamental analysis, you had to have the wherewithal to employ analysts or get time to spend yourself plowing through printed company reports, long histories of securities issuance, redemptions, and so on and so forth. And if you're familiar with the various writings of Warren Buffett, Graham and Dodd, you'll know that this used to be an extremely expensive, time-consuming, and laborious task, and it isn't now. You know, Yahoo Finance, Y-Charts, Coifin, FinChat, all these things make extensive numbers available. So getting the data isn't difficult now. SEC reports are published, you know, within a day or two of usually the press release company's earnings for the quarters at least, annuals a bit later. But the skill to understand the numbers still takes a bit of development and a bit of thought. It can be learned by anyone sensible and numerate, but it takes a bit of practice. My own background is in venture capital and then leveraged buyouts, and so that gave me a sort of good fundamental analysis grounding. What do you get from fundamentals? Well, I think you get a couple of things. I think you get a top-down view of the economy. So if you understand, you know, GDP numbers, inflation numbers, jobs numbers, all those things, you can get a sort of a helicopter view of how the economy appears to be doing on a trailing indicator basis according to official stats. And that's a useful perspective. You also get what, in my opinion, is an underrated an underused tool, which is you get to build a bottom-up view of the economy. So we all know that GDP stats are estimates. Inflation is, a lagging indicator based on a very selective set of measures, and that's true, regardless of country and regardless of flavor of administration of country. But you can build a bottom-up view of any economy by simply taking the most important companies in that economy and just looking very carefully at the revenue lines and looking at, do you have organic, non-M&A growth in those revenue lines? If so, how quickly? And what's the rate of change in growth? So is growth holding about the same level? It's 5-10% a year. Is growth accelerating, increasing? Is growth decelerating? And if you have in the US, for instance, if you look at things like Apple, Google, Meta platforms, Microsoft, if you look at all of them and they're all showing slowing growth, well, probably the economy is slowing. If they're all showing accelerating growth, then probably the economy is accelerating. The other thing that's always worth looking at is company guidance, and this again doesn't really matter for small caps or specialist companies, but for the largest market moving companies, then what the Meta platform CEO has to tell you about next quarter and the coming year, what the Apple CEO has to tell you about that period, what the Microsoft CEO has to tell you is relevant. They have to operate within very tight guardrails according to fiduciary responsibilities and so on, as to what they can tell the market they expect to happen. And of course, there's a game of beat and raise and so on and so forth, but this is at the edges. Right? So by and large, they have to give their best estimate of how their company's prospects look in the next 1 to 3 quarters. And again, if that basket of market-leading companies are telling you that the revenue outlook is fine, probably the economy is okay right now. If they're telling you that they're reducing guidance, and it's not just one company, it's not just one particular sector or one issue, if it's a group of companies that are important across the economy, probably the economy is weak. And then if they're all raising guidance, then probably the economy is okay. Of course, economies can change quickly, but this bottom-up method, I don't think people use enough. So this quarter, for instance, I've paid a great deal of attention myself to the guidance issued by the companies that we cover for this exact reason. And it's been surprisingly solid at a time when many companies would have total air cover to be able to say, we can't guide or we're guiding down because of uncertainty. They haven't. And so from the perspective of those market moving companies, the US economy looks better than the narrative would have you believe, I would say. The other thing that fundamentals give you is the ability to spot valuation edge cases. Now, for the most part, I don't think anyone sensible would buy or sell a stock because it was trading at 20 times cash flow or 19 times cash flow today or tomorrow. These small variances in valuation don't really matter. But sometimes you can see extreme cases. So Meta Platforms at the end of 2022, early 23 was trading at 7 times trailing cash flow, and yet was growing, really quite quickly. And so sometimes you can spot screaming bargains. That was a screaming buy, as it turned out. We said so as a firm at the time, and it turned out to be true. You can also spot extreme high valuations. Now, extreme high valuations can keep going. They can sustain longer than those extreme lows usually. So Palantir is a great example, a couple of hundred times cash flow, stock keeps going up. So it's much harder to say that's overvalued, I'm going to sell. But at some point, huge valuations, particularly revenue valuations, do matter and do act as a sort of brake on the stock. More usefully, I think, edge case low valuations can give you great buying opportunities in those top companies. Again, smaller microcap specialist companies, you don't have the liquidity really for that valuation to matter. But if the market hasn't spotted that Apple or Meta or Microsoft are very, very cheap, usually that's an opportunity. Fundamentals also give you an ability to spot underlying opportunities and problems in the company itself. And you would be surprised really about how many things pass by the earnings call or the analyst call. So, here's a simple opportunity, a simple example, which is most technology companies these days report something called remaining performance obligation, which is basically the size of their order book. And there's very little commentary on it in 10Qs or 10Ks, very little investigation of it in analyst calls. But what the order book is doing, how big it is relative to revenue, Is it growing faster or slower than revenue? Tells you a bit about the future of the revenue line of the company. It's not a time machine. It's not a perfect window into the future, but it's not a bad guide to, well, is the revenue likely to accelerate or is it likely to decelerate? And that's one of the ways that in our work we've been able to spot underlying opportunity stocks that we think have not responded to the opportunity to the upside yet, and also spot underlying problems. Overall, fundamental analysis I would characterize as useful but not determinative. It's pretty helpful if you like to invest in or trade single name stocks. It's not all that useful as regards if you just trade the S&P. You know, what the S&P happens to be trading at on a PE multiple or a PEG multiple isn't all that useful. But for individual named stocks and companies, it has its place. Technicals. Now, again, technicals were once the land of the esoteric chart room, where if you go back 40, 50 years, all of the large investment houses, wirehouses, would have chart rooms with huge long pieces of paper and very skilled staff who were competent in both market analysis and skills like technical drawings. A lot of this stuff was done by hand, later by simple computer printouts, but originally by hand. Now, again, today you don't need to employ tens of very expensive analysts because you can get this stuff for free off of Yahoo Finance, off of TradingView, lots of other places. The skill to understand a stock chart, again, takes a bit of learning. And there are many different methods of technical analysis, as you know. In our work, we like to use the Elliott wave and Fibonacci system, but there's many ways to arrive at good technical analysis. And in the end, all you're doing is measuring emotion, really, the way that price reacts to previous price. And that's just measuring fear and greed. And so whatever the particular tools you use, I don't think it matters that much as long as you find a system that works for you. Technical analysis is the lingua franca, the universal language of market makers. So in the short term, intraday, intra-week, the way that, in particular, the big liquid indices and ETFs and stocks move is determined by how far has price moved from where price was. You know, what is in Fibonacci land? How big of an extension is that to the upside? Okay, it's probably going to reverse to the downside now. How far has it fallen versus the recent high? Okay, it's probably going to find support there. And if you learn a system of likely pivot points and you learn to use both price and short-term volume analysis, then you're essentially learning a system of semiotics, of signs and symbols that are used by market makers to communicate with one another without any kind of collusion or anything illegal, but it's a way to see the market through the lens of the absolute market operators in market makers. It's a very helpful set of tools. It gives you the opportunity to spot potential price pivots coming up. Of course, not every price pivot is hit. Not every prediction comes true, but some do. And in my opinion, when you get good at it, you can be right a little bit more often than you're wrong, which of course is all you need to be. It is, in my opinion, essential if you adopt hedged trading, as I do. I like to use long, short ETFs in a hedged trading fashion. And understanding how to use technicals for that is critical because, again, it helps you to spot where pivots may happen. It helps you to spot where it might be opportune to place a hedge, where to release a hedge, and so on. Technical analysis, again, I would describe as useful, but not determinative. It is all you can operate purely on technical analysis if you are trading indices, futures, ETFs, some of the big sector ETFs, even some of the very big stocks, your Microsofts and Apples and so on. Technicals, you can get by with technicals without fundamentals, whereas I don't think you can get by on fundamentals without technicals. Okay, quantitative. First of all, let's define what we mean by quantitative. Quantitative in our world is a pure machine system. It's a pure algorithm. Now, clearly, in the main, algorithms are written by people. But in this world of machine learning, it doesn't take very long for the algorithm as created by the person to evolve over time as the machine learns and iterates and reiterates. And in some cases, and there'll be more of these as time goes by, AI will write the algorithm without any human involvement, and the algorithm will learn from a point zero that was not written by a human. So you can argue, I think, that human-authored quant signals aren't purely mechanical. They have a human input, but the operation and the learning is pure mechanical. Now, why we value quant services, and I'll walk you through what we offer in a moment, is it gives you ice cold analysis. If you yourself or your favorite analyst is sat there doing fundamental analysis of a company, he or she has an opinion on the company, has an opinion on, well, what is the right level of cash flow margin for that particular rate of revenue growth? What should gross margin be in a software company of this nature? They have an opinion. And that opinion, even if it's not explicitly set out in the work, will permeate their conclusion as to where they think the stock price should get to, the stock rating, and so on. On technicals, your favorite technical analyst or you yourself will have a series of patterns in mind with which they've had success before and patterns in mind with which they've had failures before. So I myself, for instance, I like the Fibonacci and Elliott wave system. There are better analysts at it, of course, but I'm not bad at it and it serves me well. I'm not very good at things like bull flags, wedges, all that stuff. I'm not very good at predicting in which direction will a wedge formation break. And so if I see one, I tend to not trade it because I'm not very good at it. And so that sort of learned experience of the human analyst will determine how they see the stock chart and what conclusion they read. Machines are not as prone to observer bias as humans because of this machine learning thing. A machine won't beat itself up because it lost money yesterday because it messed up its chart. A machine will just go, okay, yesterday was wrong, so what can I learn from yesterday? I can learn this. Okay, try to improve on that next time. It won't give itself a pat on the back if it made money yesterday because its chart was brilliant. It will just say, okay, yesterday was correct, what can I learn from that? Okay, move on. Machine learning is a real thing. We see it in the quant services that we offer. Quant alone, I think, is, again, useful but not determinative, because for now, the skill, I think, is how you interpolate human judgment with machine judgment. I'd like to talk about that a little bit. Okay, so I've talked about using fundamentals. I've talked about technicals. Technicals are, here's a great example. So last week, personally, I hedged everything on Wednesday. Market had run up. It was monthly options expiry on Friday. That's often a very volatile time. And that proved to be a pretty lucrative thing. There was a sell-off into OPEX, which I could cash the short hedge, roll that into the long side, and that was arrived at by pure technical analysis. Quant signals, I think, can be used differently, and this is how I do it. So in our work, and if you go to our website, sestriancapitalresearch.com, I'll show you what it looks like. It looks like this. It looks like this. If you go to our site, there's a tab, Quant AI. And we have a family of services called Signal Flow, which you can read about. And if you look at macro and crypto, we have a Bitcoin signal service, which you can buy standalone or as part of a macro service that we offer. Let's just flip back to the presentation right here. For me, I think that the quant services can be used in a couple of different ways. So this is what I do. I have some pools of capital where I use the quant signals as a pure money management tool. In other words, because I've spent some time with, in our case, we have two quant analysts running a family of services each. I've worked with them for many years, each of them. I'm familiar with how they think and how they've developed their algorithmic services, and I have confidence and faith in that. I've seen the services develop, and I've seen them back tested, and I've seen the live trading. So I'm confident to put capital in harm's way there. So we have one service, a long short index ETF service, and I run capital purely according to that in one account. So if that long short service says own SPY, then I'll rotate that account into SPY. If it says own PSQ, which is an inverse NASDAQ ETF, as you know, I'll rotate into that. And that does pretty well. And then the other example of that I use is we have a Bitcoin signal service, which has been doing really, really well since the April launch. And the author, Yimin Zhu, who runs it, has commented that pure technical analysis would have taken him out of a long Bitcoin trade on a couple of occasions, but the machine has kept him in. Again, because the technical analysis would have said, this has run up too far too fast. There's some volume here that looks like distribution, get out. But the machine hasn't done that. The machine has concluded that actually this is fine, this is going to keep going. And the machine's been right so far. Could be wrong tomorrow, but so far it's been right. Now, Bitcoin being, literally it's nothing other than a gambling token. We can argue that it's got money transfer, fundamental value, and a lot of other things, but in essence, it's a pure gambling token. I think it's perfectly suited to quantitative analysis because there's nothing real to it. And so you can't use fundamental analysis for Bitcoin. There isn't any. You can use technicals, of course, but it has an extreme volatility. It has a relatively small number of market moving investors involved, and so it's not really crowd psychology in quite the same way that the S&P is. And remember, technicals are there to help you measure crowd psychology and predict crowd psychology. So Bitcoin, I think, is perfectly suited to quant signals, and I run a Bitcoin account, again, purely on that Bitcoin service, and it's done very well. And I ran it on Newman's manual Bitcoin service last year and did great, and on his algorithmic service this year, and it's going very well. So it can be used as a pure money management tool. Probably nobody would put all their money to work using a signal service to which they subscribe, but I think when you find one that's good and back tests well, and you have an analyst that can explain why it makes the decisions it does, then I think it's okay to say, well, I'm going to allocate this amount of capital and I'm going to run it, purely according to what that signal service says. The other way I use them is as a sort of robot sidekick. Okay, so let me explain what I mean by that. So if I'm doing some analysis, let's say I'm looking at whether I want to be long the semiconductor ETF, SOXX, or not, and I might look at the fundamentals of the underlying semiconductor companies that are in it. I might look at the stock chart for SOXX, and I know that SOXX overreacts to market risk. Right, in a risk-on environment, usually it shoots up faster than the indices. In a risk-off, it falls faster than the indices. So what's really interesting to me is what is it that the quant signals are saying about overall market risk? So the signal flow AI set of services, for instance, have a really nice way of measuring a risk-on, risk-off environment using, predominantly the S&P, which is a very strong carrier wave of risk information. By and large, not perfectly, but by and large, if the S&P is risk on, lots of other things are more risk on. If the S&P is risk off, lots of other things are more risk off. It's not a perfect statement, but it's true enough that you can use risk on, risk off in the S&P to determine the same in other things. So if I'm making decisions about long, short semiconductor, I'll pay a lot of attention to what the Signal Flow AI S&P service is saying about risk, the risk environment in the S&P. And if it's saying risk off, and I look at my technical analysis and think, I think it's bullish, but I'm not really sure. And if I've seen a group of earnings reports recently which have been sort of so-so, then I'll probably conclude, I think I'll stay out of the long trade for now. If I have a weak set of earnings reports, but very strong technicals and risk on quant, probably go long. Because if you look back to the end of the bear market in 2022, Nvidia stock started to take off when the fundamentals were still pretty weak. Revenue growth was flat. Cash flow margins were pretty low. But the excitement about the AI trade had started to show up in the Nvidia stock chart, and the risk environment in the S&P was turning positive because it had been running in a range-bound manner sideways for some months. So quant signals for me, two ways to use them. One, pure money management, as in just do what the quant signal says for a signal that you've come to like. You've interrogated the author, usually you figured out how the model works to some degree. I don't mean mathematically, but you've learned its behavior somewhat. You've learned to work, roughly what it will do in any given environment. You feel comfortable with it. That's one method. And again, I do that for long short indices, and I do it for Bitcoin. And then secondly, as basically, as a wingman, right? So as a completely independent analyst, that's sat next to you, helping you with your work. And if the machine supports your work, you can have more confidence in it. If the machine thinks your work is wrong, then it can give you pause for thought. And of course, you can override what the machine says, or you can conclude, I don't have enough certainty, I'll keep out. And so I mentioned in the intro or the pitch for this webinar that one of the things I think that these quant services are great for is making fewer mistakes. As we all know, everyone's capable of achieving some great investment returns from time to time, but we're also all capable of making terrible mistakes. And if we can just reduce the number of mistakes, then we don't have to be, brilliant investors. We just have to make less mistakes to improve our returns. And I find that across the board, whether using it as a pure money management tool or a sort of sidekick, I find that it helps me make less mistakes. Just briefly, before we go to questions again, I'll just show you the quant services that we offer. So on the signal flow family of services, we do long-only equity. So we have a service for the S&P, we have a growth service which uses the S&P to consider the risk environment, and then it selects from a group of growth-oriented ETFs. We have a long-short index service, and we have a bond service that rotates between cash and different maturity lengths of bonds. This is a really popular group of services. The back testing, you can read about this on the website. I won't bore you with it now, but the back testing is really, really good. Live trading's been great. And this is a family of services that I use personally. So if you go to our website, sessioncapitalresearch.com, go to the Quant AI tab, and you'll find the Signal Flow series of services. The other one to look at is if you look at, again, on the website, it says Bitcoin Signal Service, click macro crypto below, have a look at this. And it'll tell you all about Yimin's overall service called YX Insight, which is terrific, by the way. And if you're interested in the things he covers, he's a former rates trader, so professional manager of institutional money. Very, very good work. Do take a look at the full service. But today, what I want to talk to you about is Bitcoin Signal Service, which he has a very simple design to it. He's not trying to be perfect with it. He's trying to beat, buy, and hold. And so it's a simple risk on, risk off tool. So he issues a signal in the morning before the New York Open, and it will simply be a signal of 1, risk on, a signal of 0, risk off. And in each of these cases, for all these services, you have to think about what does 1 and 0 mean? And this is how I think about it, which is, let's say I'm interested in owning Bitcoin and I don't own any today. And let's say I sign up for this service and I believe in it. And the signal comes along and it's a 0. I think, well, I don't own any, so I won't do anything. I'll continue to not own it. Okay. Then tomorrow the signal comes along and the signal is 1. So to me, that means, well, I don't own any, so I think I'll buy some. I'm probably not going to put all my money into that. And even in the account or the quantum of capital I've decided to allocate to that, I'm not going to probably write the check on day 1. Okay. So I might write, a tenth or a quarter or a third or something, some proportion. The first time that one signal comes along, I might say, okay, I'll buy, 25% of my planned allocation, I'll buy today. Tomorrow, another one comes along. Okay, so the model is saying it thinks, in essence, that there is not trouble ahead. If you think of it that way, a 0 means the model thinks there is trouble ahead. A 1 means it thinks there is probably not trouble ahead. So if I own a small allocation of Bitcoin and I'm thinking about owning more, I'll probably use that second 1 signal to buy a bit more. Again, not on a YOLO basis, not putting all my money to work, but another check. And then if I get a 0 the next day, then you have to decide, how are you running this? Do you just go, right, risk off, sell? That might mean taking some profit. It might mean eating a loss. But if you have developed faith in the back testing and the live trading, you might just go sell. Okay, I'm eating a small loss. That's fine. I'm subscribed to this and I'm following it to make less mistakes. So it means eating a small loss now, not a big loss tomorrow. Okay. Or in hedgeable instruments, you might decide to hedge. So in Bitcoin, for instance, the BITO ETF, which is a Bitcoin futures ETF, can be hedged using BITI. One is long, one is short. In the S&P, SPY long can be hedged using SH short, QQQ long can be hedged using PSQ short. So if a 0 comes along, you might say, well, I'm going to sell, or you might say, I'm going to hedge. And that would come down to how is it you like to trade exactly. And then when a 1 comes along, again, you take action accordingly. So you have to work out, I think, what does a 1 and 0 mean to you? It's different for each person. The model is telling you not what to do, but the model is telling you what does the model think is likely to happen the next day. A 1 for all these signal services means the model thinks things are okay. There probably isn't going to be a big crater tomorrow in the model's opinion. A 0 means things are probably not okay in the model's mind. There's some more risk tomorrow in the model's mind. And so you have to come up with your own system and your own systematic way of interpreting what does 1 and 0 mean. And if you were sat around with some colleagues running a quantitative fund, that's what you would do. The model would spit out a number and you would decide how to act on that. And this is no different if you subscribe to these services. Now, for those of you who are members of our community services like Inner Circle, we talk about this stuff all day in chat, on our webinars and so on. And so if you sign up to these services and you want to be part of a community, you can join our Inner Circle. We can help you with all these things. But if you just sign up for the signal services themselves, be aware that do work out a system for what 1 and 0 means. And of course, you can always reach our analysts to talk about that. Okay, that's pretty much all I wanted to cover today. So again, if you're interested in these things, go to sestriancapitalresearch.com. 2 areas to look at: quant/AI and macro, crypto, and that's where to find these services. So if anyone has any questions, comments, anything at all, I'm going to open mics now, and please have at it. So microphones are all on now. So anything at all you'd like to discuss, please do ask. If people would rather not discuss it live on this, then we can talk about it in YouTube comments later or any of the forum which you can reach us on. But if anyone has anything, please do fire away. Okay, in that case, we will finish up for today. We'll post the recording in a couple of hours once it's compiled and live. And again, if anyone has any questions, if you're not a subscriber of ours and you don't know how to reach us, just go to our website, sestriancapitalresearch.com, and click Ask Us Anything down here. And there's a contact form right here you can use. That comes right to us, and we'll always get back to you in very good time. So thanks for watching and listening to this webinar. And please do get in touch if there's anything else we can help you with. Thanks again.